Hi, everyone, and welcome to Duckfund Talks, where smart capital meets action. My name is Anna. I'm the founder of Duckfund. We're earnest money deposit financing platform for commercial real estate acquisition. And today on Duckfund Talks, we're joined by Michael Kondracki, CEO and founder of Wawona Worldwide Capital, a finance veteran who has structured and closed more than 20 billion in financing across corporate, project, and commercial real estate markets. From Wall Street investment banking to advising on billion-dollar lending pipelines, Michael shares what it really takes to get complex deals funded in today's market. Michael, welcome to Duckfund Talks.
Thank you, Anna. It's a pleasure to be here with you.
I love to start those expert sessions with a poetic question. So, if I'm writing a book about you, what's the title of the chapter you're in right now? And what's the one move that got you there?
Well, I'd say the chapter we're in right now is commercial real estate finance. That's what we do. We've been in that chapter for about 23 years now, and we're seeing a lot of ground up construction deals. And the quick analysis for people to take away on a ground up construction deal is what we call the developer spread. And the developer spread is the difference between the cap rate and the yield on cost. Cap rate, as you know, is NOI over fair market value. Yield to cost is NOI over the development cost. So basically, if the spread there is 150 to 250 basis points, then we know the project is viable and it's worth going into ground up construction. We're doing a number of projects. We have a project in Brooklyn for a medical office. We have a project in Queens for a medical office. We have apartment buildings that are going up in Tacoma, Washington, and in New Orleans. So we're pretty busy with ground up construction.
We have a lot of requests on equity for ground up construction, and that's something that is not easy at all to raise. So, do you guys help with raising equity for ground up?
Yes, currently I'm in the market getting my securities licenses for a FINRA broker-dealer. In the United States, you really need a securities license to be able to raise equity for real estate projects. So what we've done is we've partnered with '07 Capital this year, and they have access to a broker-dealer in Denver, Colorado, that we're probably going to join up with to facilitate raising equity for ground up construction, for cash flowing assets, etc. So that's definitely on the radar screen. We have a registered rep right now that's handling things in that regard, and hopefully I'll be joining him soon.
Can you help me understand what's the secret sauce? Why for everybody it's so difficult to raise equity for ground up construction? And what is something that you see in those deals? Is that the spread which you mentioned at the very beginning, or there's some other components of success to make sure that for a ground up construction, a sponsor can raise LP equity?
Well, that's very interesting. I would go back to the fundamentals, which I determine through my lending years are the 5 C's. And the 5 C's are basically borrower reputation and credit history, their character, borrower ability to repay their capacity, capital, does the borrower have the financial resources, collateral, the property pledged, is it enough to secure a loan? And conditions, what are the interest rates, loan amounts, external conditions, the economy that impact the capital structure? Now, many people don't understand why, but I can tell you in this marketplace, lenders are loath to quote construction loans without having the equity raised first. So it's a very critical component. And I think a lot of people think they can get by without much skin in the game, but really, when you're looking at it holistically, you have to know that the borrower has the financial wherewithal and net worth to carry the debt structure he's desiring or she's desiring, as well as putting at least 10% of the equity stack in with their own capital. So unless we have those components, we really have a struggle there. And I think that's why most people are struggling, because they either don't have it or don't have friends and family or partners that can put in that 10% strip. A typical general partner wants to put in 90%, 80-90% of the GP money, and maybe we'll bring in limited partners for the balance. Those are typical structures we see in this area.
So basically, to paraphrase, what you're saying is that if you want to raise LP equity, you need to have at least 10% of your own capital of the total cost. And
Yes.
then you're getting what, 70% of the loan, and then in this scenario, if you have everything in place, you have an ability to raise another 20% as LP equity. Is that what I hear?
I believe that's rough, correct, back of the envelope. There is no set pattern. We see sponsors come in with 30 or 40% of the equity in a deal that's needed. We've been blessed by having really good sponsors come to us these days, but it just shows you where the market is. Some potential GPs and LPs like that because it shows that they have the wherewithal. Also, I want to mention that with regard to leverage, it's important that the sponsor group have a cumulative net worth at least equal to the loan balance and liquidity of another 15 to 20% beyond the capital structure, just in case something goes wrong, like cost overruns.
So is it a requirement which a lender normally put in place?
Yes, those things I mentioned are definitely looked at in this market. And the other factor that I see very saliently is metropolitan statistical area. There are about 40 or 50 of those in the United States that qualify as regional metropolitan statistical areas. And we see that the equity people and the debt people are, lenders and equity providers are trending towards only lending in those markets. I'll give you a couple of examples. Dallas is a major metropolitan statistical area. El Paso is not. El Paso is tougher to raise equity for. Similarly, suburbs of Seattle may be more difficult than if we were in Seattle proper.
I hear you. And what about the asset classes for ground up construction? What's the trend right now? What's the easiest asset class to raise LP equity?
As always, multifamily is the easiest, then industrial, self-storage, retail, hospitality is the toughest.
And what about affordable multifamily?
Well, affordable multifamily, I think if the cash flows make sense and the potential return is there in terms of IRR and equity multiple, it'll get a good look over. It's not so much that the asset class is a turnoff to people. It's more or less, do the metrics make sense?
Interesting. So how do you guys operate? So you do consulting work for developers, right? So you help them raise equity and debt, correct?
Well, yes. Right now, legally, I'm able to manage debt offerings. With regard to equity, I have to turn that over to a registered rep at a FINRA broker-dealer so that it complies with US law. So I'm not registered yet. It's one of my intentions this year. But yes, in broad terms, we can handle both. It's just that I can't say that I can personally. I would have to refer them to my colleague.
For lending products, what's critical? What do you look at? You're saying cash reserves, net worth of the sponsor group. What else?
Well, I think every project is different. Whether you have a cash flowing entity that's looking to be acquired or to refinance, everything comes down to cash flow, debt yield, debt service coverage ratio. Because when you're talking to major lenders like a Natixis or a Goldman, they're going to want to look at those fundamental metrics and make sure they make sense. Then they'll dig into, so there's a project level analysis, right? A asset level analysis, and then there's the sponsor level analysis. So I think, some of the metrics we talked about are very relevant there.
In terms of timing, normally, how long does it take to get loan in place and what it basically depends on?
Well, that's a very, very good question. I call commercial the paper chase because, and it's the wild, wild west because people expect things to close very quickly in 10 to 14 business days. But realistically, 30 to 45 calendar days for a well-prepared borrower is de rigueur. And generally, what you find is that in underwriting, anything can happen. Underwriters have very searing questions, and they may want to know more about the project, the asset, the sponsor, all kinds of things that we didn't think of in the beginning as much as we prepare the borrower. So an appraisal today takes 2 or 3 weeks on itself. And then, you're trying to underwrite, you're trying to get all the required paperwork in for the bank, the fund, the insurance company, the hedge fund, the private debt fund, whatever the lender is, so that they're comfortable that when the appraisal comes back, it won't be too long to closing. But all these things are moving parts. And what we find is that borrowers consistently don't meet expectations in this regard. They're always a little tardy. It always takes more time. And that's why I go back to my original comment, which is commercial is the paper chase.
Is there some movement towards automation of the process,
Oh,
combining
good.
the process to one software so that it is facilitated somehow? And now with the growth of the role of AI, are there any players in the market who try to use the technology to kind of streamline the process?
Absolutely, Anna. In fact, we use AI at our firm very judiciously on the outset of a file. So, for example, for a while, we still have the paper chase of collecting the main documents, right? The personal financial statement, real estate owned schedule, P&Ls that are what we call T12, the latest 12 months, rent rolls, those basic things. Then we put them into the AI system, and the machine learning can write an offering memorandum for us in minutes. Once we have that offering memorandum, we have to edit it because machine learning still isn't perfect. And, after maybe a half hour to 45 minutes with that, we take the memo and the files and we use AI to identify our lenders. Now, in that system, we already have input thousands of our own lenders, and the machine has another few thousand. So when you think about the lending market in the United States, there are probably over 10,000 lenders in the United States. And as a result, we get the best of the best. I'll give you an example. But just to finish up, after we select the lenders, it'll use our CRM to contact people, and then we follow up either manually or we have the machine follow up until we get what we want, which is a quote, right? A soft quote. going back to the process, the offering memorandum saves us a lot of time there. So does the identification of lenders, because my colleagues used to complain it's all in my head, but now it's easily done with the machine. So
Yeah.
all my intrinsic information that I had for years is in that database. So it's very efficient and it saves us a lot of time. An example I was going to give you earlier, which I'll now state, is we had a condominium project in South Dakota, and South Dakota is a very difficult state to find lenders, but our AI program found lenders in South Dakota, and in 24 hours we had quotes. And I have
Oh,
to tell
wow.
you, I was on the phone with a sponsor last night and they were very impressed because they had been looking for a long time.
We here at Duckfund, we use a lot of AI to streamline our processes.
Oh, yes.
And, we can deploy capital within 48 hours of an application, and that's our,
Wow.
value proposition. Our underwriting is not that heavy as yours. At the very beginning, before we automated the whole process, we did it all manually. And it was a bottleneck because we were not able to serve a lot of customers simultaneously. And
Sure.
now with the incorporation of technology and all that, given that we have a standard procedures and the product itself is pretty standard, it's getting easier and easier every day. So I hear you. It's really good to use AI and to use technology in processing all those applications. Do you
Oh,
guys use AI as well to find prospects, to find your customers out there, or?
we're interviewing a number of firms in that regard. And Friday, we have a big team meeting with a firm that is pitching us. So that's the next angle we're going to work on. I mean, we get so many referrals from people that have a hard time that honestly, we haven't gone that far yet because 2 or 3 to 5 leads come in every day. So I could be working on something. I'm surprised the phone hasn't rang yet during our interview, but it's very busy. We're just very busy. So I don't really have to turn that on yet, but once I do, then the people on my team will have a lot more responsibility.
That's true. Going back to the sponsors, what's your advice on the healthy capital stack in the ground up construction?
Well, that's a good question too, because we've seen a lot of, particularly in Texas, a lot of multifamilies that were acquired in the 22 to 24 area now underwater in their capital. In other words, the net operating income is not sufficient for debt service. So, say leverage is a tool, but one that must be taken on with sobriety. Perhaps the cycle of the Great Recession in 2008 was the most dramatic downturn we've seen in that regard, when Bear Stearns and Lehman went out of business, being sold respectively to JP Morgan and Barclays, right? When the stock market crashed, a lot of people lost money. The market was down $5 trillion in the meltdown, and that exacerbated unemployment. It saw residential mortgages default spike, and
Yeah.
people lost a lot of their savings and employment. So I think that the same thing could be said at that time for the commercial mortgage-backed security market. The only similar time we had that saw this many defaults was in, the COVID time. So yes, it's important that sponsors look at ultimately what leverage is appropriate with regard to the capital stack. Generally, lenders are in the 65% loan to cost area, traditional lenders with
Yeah.
rates of SOFR plus 200 to 350, something like that. Debt funds are in the SOFR plus 400 to 500, maybe more, depending on what the risk is. But there are people that will stretch to 70, 75, 80%. loan to cost. It's really a matter of market, sponsorship, and fundamentals of the cash flow that's to come. Demand for the product, right? And believability of the feasibility study and the market studies. Because ultimately, if you build it, will they come, right? The demand has to be there ultimately, otherwise it's a big risk.
Yeah, but the future NOI is still a hypothesis. You never know,
Correct. You
right?
don't really know. The only thing you have tangibly are the comparables in
Yeah.
terms of sales and rentals. And that tells you more or less up to the minute of the appraisal where the market is.
Yeah,
Could
but it takes some time to develop the project.
These are long lead times. A project may take 12 to 24 months to build, but it probably from raw land to entitlement, that's a whole process in itself, where the pre-development may take 6 to 12 months, depending on how difficult it is to get the entitlements through the political structure. So there
Yeah,
are a
I
lot of
agree.
moving parts with construction. I happen to like construction because in my prior years, I was in project finance at Deutsche Bank. So for
Mm,
me, I used to finance heavy power plants with gas turbines, gas pipelines, oil pipelines, and oil fields. So that was
hmm.
a whole different genre, if you will, of
Yeah.
my career.
Interesting. We talked a lot about what a sponsor should do to get the capital stack in place, but I wonder how the sponsor should choose the lender. So there are, as you said, 10,000 lenders out there. And what's important for the sponsor to understand about the lender, and what might be a red flag from scratch? What difficulties might they occur in the process?
That's also an excellent question. I think, you want to look at a lender in terms of their own balance sheet and their default statistics, right? Is their underwriting adequate in relation to their portfolio? Do they have a large default statistic or a low default statistic? That's what really determines the better lenders. And that statistic is available on the FDIC website for most banks. In the
Mhm.
private credit market, a lot of that is in the newspapers, whether it's FT London or New York Times or Wall Street Journal or Bloomberg. But getting back to what one should look for, I think consistency. Have they done this before? Do they have case studies that they can talk about where they've managed to do construction for the same asset class or similar asset class? So their track record is very important. You don't want someone that's in there for a loan to own loan. You want to have someone that's willing to work out if something goes wrong and has the experience, the track record behind them to face this kind of challenge. Because there are cost overruns from time to time in construction. There are, just managing a draw schedule to get the money to the project. One really has to talk to the lender and find out, well, what is that process and how long can it take to get my draw so that I'm in the ground, I'm building, going vertical in an efficient manner. Those are some of the things I would look at.
That makes sense. And if somebody is doing, let's say, mid-sized check development projects and they want to jump into different league with bigger projects, higher investment budgets, etc., what your advice would be, and what is your opinion about finding a co-GP in this scenario so that folks can, combine their balance sheet and their traction together and become a kind of stronger and better group together to approach bigger projects?
Right. I think bigger projects require a quality team surrounding the sponsor, whether it's the general contractor, making sure they have what we call a gross maximum price contract, the bank or the lender, making sure they have the track record. The architect, has he done these before? Are there renderings and drawings available? It all depends on how far along they are in the process. But I would say if one surrounds themselves with a quality, experienced team, that's half the battle. Because lenders do look at that, and it makes or breaks larger deals. And I've seen some things in my time where certain elements were lacking, and it just, required a restructuring of the whole transaction. So if certain elements are not up to speed in the lending community, it's fairly well known right away, and sponsors need to have flexibility to adjust. There's also the question of recourse versus non-recourse. A lot of sponsors will opt for non-recourse if they can. It can be found, it's difficult to find, but it can be found. But generally, most loans for construction are full recourse or recourse that burns off once the project has its certificate of occupancy. So sponsors, again, going back to the 5 C's, right? The character, the quality, the ability to repay, all that comes into whether or not a lender is comfortable with recourse or non-recourse.
Makes sense. And last question, looking at the sponsors you work with right now, how do you see earnest money deposit financing being leveraged as a part of their capital strategy? Something that is useful, not necessarily useful? Is it a red flag for the seller? Is it a red flag for the lender? Or on the contrary, it's something positive that can help the developer to save some cash for initial due diligence and initial construction work before they get the construction loan?
I think, earnest money comes in when one is about to sign a purchase and sale agreement. So many times when we're looking at land, just land, we're finding that there may be an issue with the deposit. So a firm like yours financing that deposit could be of interest to many of our clients. These are clients that are smaller, they're doing maybe 9 or 10 single families in Connecticut or New York or New Jersey in the tri-state. And they may want cash for, as you said, the entitlement process or other things they must address. So yes, I think financing a deposit is interesting. I don't think it would be looked at as negatively, particularly if it's explained well to the seller. We find that many sellers are willing to carry paper to facilitate a purchase, and that's also a tool that could be used to supplement them. They may take a second mortgage for part of the purchase price because they're interested in closing more quickly.
Yeah, that makes total sense. And we actually never had any pushbacks from the seller's side or from the lender's side. And how we like to explain that if you put a fully refundable deposit and you use your own cash, you do not actually lose or spend anything, because you can terminate the purchase and sales agreement before the end of the due diligence period and you're gone. And if you use our service, you still need to pay the fees, which is kind of your commitment that you really want to pursue this opportunity. So, and that's a part of our underwriting. Is the customer willing to pay the fees up front or no? And if the answer is negative, it's a no-go for us, because the customer needs to have some skin in the game anyway.
Oh, yes, absolutely.
Yeah, that's important for us as well.
Sure.
Michael, thank you very much for joining us today on Duckfund Talks and sharing your insights on building and funding complex deals. Thanks everybody for listening. See you next time on Duckfund Talks. And in the meantime, good deals and good luck.